Welcome to Candid Conversations for Financial Markets podcast series. I'm your host, Laura Paglia, President and CEO. Our podcasts are designed to provide insights, transparency, and provocative yet achievable proposals for matters that move financial markets in Canada. We are delighted to have with us today Dr. Pedro Gurrola-Perez, Head of Research at the World Federation of Exchanges, the global industry associations for exchanges and clearing houses. To answer, why do some markets consistently attract more IPOs than others? And he will provide us with a global view. The World Federation of Exchanges works with standard setters, policymakers, regulators, and government organizations around the world to support and promote the development of fair, transparent, stable, and efficient markets. Before joining the World Federation of Exchanges in October 2019, Pedro worked at the Bank of England, where he led the Financial Market Infrastructures Directorate's research team. Prior to that, he spent time at the UK Financial Services Authority and held positions at a range of academic institutions, including the University of Barcelona and the Instituto Tecnológico Automático de Mexico. Pedro has published across key academic journals, including the Journal of Financial Market Infrastructure, the Journal of Risk, and the Journal of International Finance, and the Journal of Future Markets. Welcome, Pedro.
Thank you very much. Very happy to be here with you and to share anything that could be useful.
Well, in November 2025, the World Federation published a report titled Attracting New Listings: What Shapes IPO Activity Across Markets. The paper examines the factors associated with IPO activity across 79 global exchanges from 2002 to 2024. How would you characterize the evolution of the IPO landscape over the last 5 years in particular?
Yes, so when we look at the IPO landscape in the last 5 years, probably 10, what we see is two different stages. So there was a clear positive trend that started probably in 2007 or so, and it goes all the way to 2020. So in this period, it's clearly a positive trend where we see IPOs globally increasing. And then we see in 2021, during the pandemic, a very significant increase in IPOs all around the world. And this is both for advanced economies and for emerging and developing markets. After that, from 2021 until now, what we see is a decline in IPOs around the world, in the number of listings around the world. And this is something that is common both in advanced economies and in emerging market economies. And if we think about the specific case of Canada, what we see is a very similar pattern. The conclusion seems to be that although there are some elements which are specific to the Canadian market, in general, the trends are the same as we observe globally, especially with its peers, with advanced economies.
Why should Canadians care about the decline of public market participation in their country, which you've described as generally in line with what is occurring in other advanced economies?
Well, I think that's a very good question, and it brings us to the important question of why public markets are important. Strengthening public markets is essential for efficient capital. I would say three things: efficient capital allocation, economic resilience, and long-term growth. In terms of efficient capital allocation, as you know, the markets are there to bring together investors and issuers or sellers of assets. So it's a way of bringing together firms, for example, that need funds to grow, to invest, to do research, and on the other side, the investors that have the funds, that have savings, and the way of matching these two in an optimal way so that the capital is allocated optimally is to bring them to a marketplace. That's what the exchanges do. They bring these two parties so that the allocation of funds is optimal and as efficient as possible. And this is supported by an efficient price discovery process. So one of the things that we all know, for example, markets that are not efficient, like the real estate market, like the car market, we don't have usually enough information to determine exactly what's the good price for a house, what's a good price for any other illiquid asset. In the case of equities, the markets are efficient in the sense that by bringing together all the information in a single place, all the information is compounded into the prices, and we know that the prices reflect the actual equilibrium of the market, the right price that we have to pay for a particular share of particular instrument. So having an efficient market is fundamental for price discovery. And then you have a more systemic component, which is about financial resilience. If you think that in times of stress, usually debt markets dry up, and the markets still stay there to provide funding where it's needed. And a very good example was the pandemic. During the pandemic, it was a important economic shock, and for many firms, coming to the markets was a very efficient way of raising funds quickly to strengthen their balance sheets. When at the time when the traditional banking system was under stress, so the financial resilient aspect is also an important aspect. And then you have other elements that we all know that are investor protection. You have a high degree of investor protection because these are very strongly regulated markets. You also have a lot of transparency. You can see what are the prices at any point in time, and it's a very democratic and inclusive process. Everyone can come, everyone can invest, retail, large institutional investors, and all the prices and the mechanism is transparent. So it's a very important part of the economy.
In your research, did you run across any facts that surprised you or challenged what we see as conventional wisdoms about IPO markets?
Yes, well, in some sense, research has been done. What perhaps was less expected and was a little bit of a surprise is that the factors that drive IPOs are not the same when you think about advanced economies and when you think about emerging economies. It was also interesting that some of these drivers have a different impact, whether you're thinking about the frequency of the IPOs or where you think about the size of the IPOs. So to give an example, one of the results that we got was that a more stringent regulation not so much affected the frequency, but did affect more the size of the IPOs. And one reason that could be behind this result is that if you have a more stringent regulation, then in some sense that's operating as a filter, and only larger firms can afford to go through that process of listing, given that those requirements are more stringent than in other cases. So I think that was those type of very more detailed, granular pieces of information were very insightful for us and somehow surprising.
So then to summarize, in understanding the IPO drivers, in answer to the question, why do some exchanges consistently attract more IPO activities than others, what would be your main findings?
Yeah, well, that's probably the holy grail for IPOs because I know that many exchanges are thinking very intensively on these questions and trying to add some more firms to their markets and bring them and convince them to list. In general, I would say that there is no, one fits for all recipe. What we see is that there are some market structure differences. For example, in terms of market liquidity, when you have higher liquidity, higher trading volumes, that seems to be correlated with an increase in IPO demand, which is natural. The more liquidity you see in the market as a firm, you feel more comfortable in coming to the market because you would expect a more efficient price discovery for your shares, more efficient pricing for the value of your company. Other elements which are related to the market structure could be, for example, the stability of the market. If you have lower volatility, that tends also to be related with a larger number of IPOs, simply because if you have low volatility or you're at a time of low volatility, then firms have more incentives to go public because they realize that in a low volatility environment there will be not many surprises on the pricing of your shares. And then there are also structural differences at country level, like how developed are your markets, what are the conditions in terms of interest rates, etc. To that, I would also add that there are important regulatory differences, and we will talk probably a little bit later about that part of the story, which is the requirements. But that also makes a difference because the requirements set up a filter that can encourage or discourage firms to list. And finally, I think that there are also elements which have to do with the cultural differences and financial education. There are countries where investing in the market for a retail investor is something that is almost normal. It's part of their investment portfolio. They're thinking about retirement. And in other countries, there's no tradition of that. So it's more difficult to bring those investors and bring liquidity to the market. And the same on the side of the firms. In some markets, in some countries, there's a long tradition of family-owned firms that are not perhaps inclined to let ownership be shared in the way it's done in a public market. So they are less inclined to come and list. So this is a very, say, multifaceted and complex picture that individual countries have to analyze in particular. We see that in advanced economies, market stability is a very important driver, whilst in emerging markets is more about market liquidity and financial development when we think about factors that are decisive in terms of bringing IPOs.
With respect to the elements that marketplaces can control or can replicate, what are the biggest lessons from the markets that you would see as succeeding at IPOs?
Yes. So, of course, some of these things, as you correctly point out, are not controllable by the market. I think some of the markets that we have seen increase the number of IPOs or having a very significant success in bringing IPOs, where previously there was not so much. It has to do with, first of all, there are some exchanges that have been very proactive in marketing their IPOs, going out to their local companies, small companies, trying to convince them and also show them what are the benefits of IPOs, bringing them into a process of stewardship where they prepare them, almost partner them, in partnership with them, preparing them to go through the IPO process. This is particularly relevant with SMEs, and in some cases, and many cases, markets, what they have done is to create a specific segment in their market, which is a alternative segment or alternative market, which is dedicated to SMEs, and in some cases even to specific areas or segments within SMEs, maybe the technological sector, or maybe the health sector, where the efforts of bringing those type of firms to the exchange are tailored to the specific needs of those type of firms. There's also, of course, I think probably the most immediate way of stimulating IPOs is in the hands of regulators, um, providing tax incentives to firms that go public, making easier for them to go through the listing process, disclosure requirements which are more flexible and less paperwork and more efficient. All those are elements that could certainly be beneficial for the process of IPO.
Yeah. Thank you. Zeroing in particular on the differences for the drivers between smaller companies and larger established companies from seeking public listings. You mentioned tax incentives. I'm assuming everyone likes those. But but what are the key differences between what the smaller and the larger companies look for?
I think, yes, I think, of course, tax incentives are probably good for both for big and large, but some other things are particularly more relevant for the smaller ones. Because if you're a smaller company and you may not have a very large uh, department dealing with regulatory requirements, it becomes can become very, very burdensome for you to, go to a series of disclosures that are um, too onerous to you because of your size and your starting, etc. So if you're a small company and if you're making some profits, you probably need to invest that on growing, on research, on reinvesting it, rather than spending it on some paperwork. So I think that's the thinking of many small companies that are reluctant or don't see the listing process as a natural way at that stage of their process and their growth. So from that perspective, it's clearly something that exchanges and regulators need to think about if we want to bring those companies into the public space and find ways of preserving investor protection without or preserving investor protection, but at the same time considering the needs of smaller companies and their capability of meeting some requirements.
Thank you, Pedro. I wanted, with respect to the regulatory frameworks and the listing requirements in particular, the World Federation of Exchanges paper introduces a listing stringency index, LSI. What is that?
Yes, so that's a very interesting. I'm very enthusiastic about it because I think it's a very good idea. So when we were doing the analysis, it was clear that you have one of the drivers of more or less IPOs has to be linked with the regulatory requirements. So regulatory requirements have different dimensions. You can have requirements on financials of the firm. You have requirements in terms of voting rights, of the fees that are charged during the IPO, the costs of underwriting, etc. So there are different elements that are certainly part of the decision or not of a firm to go public. So because we were doing a econometric analysis, we needed to have to condensate all this into a numerical measure, a numerical metric. So what we did is we thought, well, why don't we look at all these different dimensions that are part of the requirements for listings, financial requirements, tax incentive requirements, IPO fees, governance requirements, disclosure requirements, operational requirements, etc. So in total, we had 9 different dimensions. Within each dimension, you have different aspects. So, in terms of financial requirements, so you may have minimum requirements, and you may have other types of financial conditions that are part of on each jurisdiction are part of the requirements to go listing, to go public, to list. So we thought, well, we'll bring that into an index. So what we did is we took these 9 dimensions, we specified some numerical values that reflect whether you had or not the requirement, and we came out with a scale, with an index that goes from 0 to 100. If you're on the 0, means that you don't have any requirements at all. Of course, no one is in that place because there are always requirements. And if you're in the 100, means that you have all the possible requirements in place that can be think of. So that's also an extreme that we don't see. Most of the exchanges fluctuate their index, their value of their what we call the listing stringency index. Their value is somewhere between 30 and 85, more or less. So this was a way of summarizing the strength of the stringency or the burden of the requirements in a particular jurisdiction. It's a very, I think, interesting way of being able to compare across different regimes which one is more or less stringent.
So if you're an exchange or a regulator, what's the best way to make use of the LSI?
Well, it's important that the LSI is not telling you what is the optimal set of requirements, not telling you you should have A, B, or C at these particular levels. It's telling you where you sit with regards to the overall global picture, or where you sit when you compare with your peers.
Yes.
And that is, so for example, some exchanges have already asked us for their the numbers, their index, how they are, at what position they are within the index, and this tells them whether they are being less or more restrictive than their peers, and whether and which particular dimensions they are more or less restrictive. So it can help both regulators and exchanges to discuss potential areas that could be improved, or where they can find some space to relax, or to address some of the things or some of the metrics that could help them improve their IPO numbers. So just looking, for example, on aggregate, you can see that some countries in Asia Pacific tend to be, or some in general, the aggregate index for America tends to have higher IPO fees than other countries, or that governance is different across Asia Pacific or Americas or emerging markets. So this type of comparison can gives you an insight of what things you can be or should be looking at if you want to increase or improve your the level of requirements in a way that, first of all, allows you to be aligned with your peers, and at the same time allows you to increase your IPO numbers.
So on that note, as you've referenced, and as the paper shows, regulation has a role in shaping what IPO markets look like. And the conclusion that was reached is that the stricter the listing requirements, the larger the IPO sizes, but not the number of IPOs. So if listing requirements are relaxed, can we conclude that you are more likely than not to see more IPO listings and more capital raised?
I would encourage, first of all, to look at the individual jurisdiction to see what are the conditions and where those that relaxation could have a higher impact. Overall, as you say, the results have found that stricter listing were associated with larger IPOs, but not necessarily more. So in principle, on average, if you reduce requirements, you will improve your IPO numbers. But I again say this is for the reasons we discussed before, and we were talking about the very specific conditions that different markets have. These are results that are should probably be read in the context of individual um, jurisdictions. In the paper, we don't provide exchange level results, but what we have observed, and that is correct, in line with what you just said, that was that regulatory relaxation was when we observed cases where relaxing regulation was followed by higher IPO activity in the next periods of quarters. What we are currently exploring is whether this is a pattern that persists in time or whether it was driven by some other event. So in principle, the evidence points in the direction that yes, regulatory relaxation could bring higher IPO activity, but as I said, there are particularities of country particularities and also the need of having a longer time series to ensure that this is a persistent effect.
So, based on the research you currently have available, are there particular regulatory reforms that have meaningfully increased that activity in certain markets?
Yes. So as I said, there are cases we have seen where the IPO activity has been a consequence of regulatory relaxation. And there are some levers that I think are very directly related, one of them being the providing tax incentives. These are very direct levers in the sense that they have a direct economic impact on the cost of becoming listed. So whatever measure you take that has a direct impact on costs, that will have a direct impact on the activity and the listing activity.
Are there any particular examples of policy changes that led to what would be a positive, measurable increase in IPO activity?
Well, if we take away, I think policy changes are a little bit more difficult to measure. So we don't have specific policy changes in the model. So we look at tax incentives, we look at regulatory changes. But when you think about policy changes, and we haven't taken that into the model because they are a little bit more difficult to quantify and to put specifically in the model. So I can think of policy changes. So for example, a policy change that will certainly be beneficial is to, and we may want to talk about this later, to create a level playing field between private and public markets. Politically, there's an asymmetry there that is very much moving the balance in favor of private markets, and that has consequences.
If you could make one recommendation to exchanges to bring their levels of activity up, what would that be?
I think it's difficult to give a general indication, but I think that I would first of all, I think from a practical perspective, I will go and check I would say go and check your LSI number, see where you are, see what are the potential places where you can improve and make a better, a better place for the firms to come and list in terms of regulatory requirements, see where are your peers, etc. And then I think that there's a good point for exchanges to be to engage, to put more to I would say educate your regulators, because sometimes the regulators are not fully aware of the relevance of the public markets and why they are important for economic growth and all the reasons that we spoke at the beginning of the conversation. So, regulators have a big responsibility in making their markets efficient and helping them to becoming and helping economic growth. So this educational side of the story, I think, is a very important thing to do because it's in the hands of regulators much of the levers to make the markets more efficient and more liquid, and that means bringing more IPOs.
So thank you. You mentioned you made reference to private capital, and we hear and read a lot about the rise of private equity. So is the rise of private equity a long-term structural challenge to public listings?
Yes, so I guess the answer to that depends very much on whether there's any policy action, or things are left as they are currently. So there's a big difference between private and public markets, and this difference has generated some distortion. So when you think about disclosures, you think about governance, you think about sustainability, you think about investor protection, about market abuse, you find that public markets have a very comprehensive framework on each one of these categories. So investors come to public markets and they have uh, the top investor protection that they can get. They have a lot of disclosures around sustainability, comprehensive disclosures around governance, etc. When you look at private markets, all of these are either limited or non-existent at all. So of course that's not a level playing field, and the consequences of that are various. One, of course, is that there's some investors' risk there that we don't know what's going on with them, especially for retail investors. The risk of those markets is opaque. We don't have data. We don't know how valuations are done. The secondary trading is opaque. There are risks because of the interconnectedness of these markets. So overall, it's not a nice picture. So of course, public and private markets have different roles and they are complementary. But we think that it's important to have a level playing field, and for investors especially to have the same protection and guarantees and disclosures that are typical of public markets. So this effectively is distorting the market. So what we see, for example, is that private markets capture early young firms, but they keep them for a longer time now. So it's usually the case, or it tends to be more the case, that public markets end up with issues that are in the stage of lower growth. And this asymmetry makes it's distorting the function of the private and the public markets. So there are many reasons why we think it's important to have a proportionate regulation, to have a equivalence in standards between private and public. And if this happens, then we'll probably see the trend on IPOs reverse.
Keeping our look at the future and future market design, tokenization has certainly been making its mark. Could tokenization change how companies access capital? And that's through moving away from a one-time IPO event to something that's more continuous, digitally enabled financing, and therefore impacting liquidity.
Yes, so thanks for that question. The organization is really, really on the table. I would start by, challenging your premise, because IPOs are not the sole events that listed companies have to raise capital. In fact, they have the option of secondary issuance, not to talk also about issuing debt, but even secondary issuance is a big deal too for them. And for example, there was a blog recently from NASDAQ where they put numbers, and they were saying that secondary issuance in 2024, I think, was 5 times larger in terms of capital raise than the IPOs. So it's a very, very important part of the benefits of being listed, is that you can raise capital at any point in time by secondary issuance is much more easier than the initial IPO. You usually get less paperwork and less requirements to meet. So the firms really have that option already to raise money outside of the IPO space. Now, the tokenized point, one thing that we are trying to stress is that there are two versions when we talk about tokenized. We have two versions of, and it's important to distinguish to see what really means. So on one side, you have what we call mimic tokens, which are really not equity, but they are more like a derivatives on the line. And these have the problem that they are, investors may come to these tokens thinking that they get the real thing, and they may not be getting, for example, shareholder rights. So they will be, misled in that sense, and that will create a reputation risk to the issuer. And on the other side, you have real tokenization, which is what some exchanges like Nasdaq or NYSE and DTCC are doing, in which you have all the rights, and it's essentially the same thing that's holding the token, that holding an equity. Now, having make that distinction, certainly there are some benefits on tokenization. So, for example, we can see some use cases that are interesting. So the fact that you have a tokenized asset may allow the firm to speed some corporate actions because they have a direct data of the beneficial owner of the share. So shareholder votes, dividends, etc., could be streamlined. It could also, tokenization could also improve some post-trade operations, particularly moving collateral, which if we think about cross-border collateral movement tends to be somehow complicated now, and tokenization could bring additional efficiency to that. So certainly there are some use cases where tokenization could bring efficiency to the process. But I would say that these are incremental improvements. It's not a radical change of how the market works. And public markets are already very incredibly efficient. So I would think that some of this will prove to be an interesting use case, but I don't think that definitely it will not change. I would definitely say tokenization will not fundamentally change the world and the markets as we know them.
And looking ahead, how do you see global IPO markets being shaped over the next 5 years, and even farther ahead, if we can, over the next 10?
Well, that's in the present context. That's a very a more difficult question than usual. I think that for the reasons that we have been discussing, I think that in 5-10 years, exchanges will be doing very much the same, simply because they perform a very relevant function, and I don't see any other way of capital allocation efficiency being met. So the IPO markets will be there. I would think perhaps that there's a different balance in terms of, there could be a different balance in terms of smaller and bigger companies. So I think it could be that SMEs become more interested in the capital markets. We've always seen many markets which have been very successful with SMEs, and we see countries in different regions of the world where the SME world is very important. On the other side, you have also new technologies allowing retail participation in a way that was not available 5 or 10 years ago. So the more retail, which is young people, technology savvy, happy to go and buy shares in their mobile, all that will bring a different perspective and a different stimulus to the way markets operate. So I can see more SMEs coming to the market, more retail coming to the market, and that will shape probably the how IPOs look like in 5-10 years. And there's But on the other side, I see also some risk, because we see in some cases that there is this idea that to stimulate innovation, we can relax investor protection, and this type of thinking, I think it could be dangerous, and that could be there could be a disaster waiting to happen if we allow decreasing or relaxing regulation, forgetting about investor protection, and allowing especially retail investors to go into markets with lower regulation. And I think that's probably some of the risks I would see in the near future, potentially, damaging the markets.
Pedro, thank you very much for sharing your insights. Extremely helpful and extremely important. Thank you.
No, thank you very much. It's been a pleasure to be with you, and thank you for inviting me.